Where we are now, we have had a good start to what should be, future being uncertain and undeterminable, should be a good year. This is a one-month chart of gold. As you see, we didn't have an end to the year as we would have liked, but so far, January has been very nice to us. Let's pull out a little bit. Gold, 3 months. You can see just at the tail end of that post-election big correction that we had, the first really big correction in this bull market that began late February last year. That's the first one that broke some trend lines and really rattled some nerves. But you can see we have been trying to recover from that. We're trading in a bit of a range and trying to recover. Go back to last year about this time. I can't remember if this was for the MIF here or the one before PDAC, but you can see the challenge last year that I took from our chart was that, from my presentation last year, was that we were bumping up against $2,100 in 4 different times. And were we going to finally break clear of that resistance line that we had hit over and over again? Well, yeah, we did. We did, and we can moan and groan about what the gold price has done, but that's a hell of a good year. We have come a long way, and no one would have dared from this podium a year ago to predict what we've already experienced. It's been a hell of a year. We've come a long way, baby, if some of y'all can get that reference. I think most of you in this audience can, although some of you won't. This is gold's new challenge. I did this chart on the plane flying up here on Thursday, and those trend lines, converging trend lines, that triangle, gold was bumping up right against it. I updated that chart this morning, bleary-eyed after the speaker dinner last night, but I did update it for you, and you can see that we have broken out through that trend line. This is quite encouraging. This is good. This is what we needed to see, and judging from this, it seems likely, a very good chance, that we're going to challenge our previous highs and get over that new challenge, the new resistance at $2,800 at some point in the future. There are some caveats. If you look at gold's relative strength index, it's kind of Goldilocks right now, right in the middle, about 50, neither overbought or oversold. So nothing much to glean here. One note of caution is gold's open interest, the paper gold market, as it were, in the COMEX. The interest has jumped considerably. Now, we don't know why these people are buying, if they're longer-term holders, if they're traders. Most likely, if they're buying on the COMEX, this is extremely hot and fickle money. So they come in heavily and they leave heavily. So this is somewhat of a caution flag that we're seeing right now. This is an interesting chart I've been featuring for a while over the past year, primarily since early summer, but really going back to the beginning of this bull market. Gold's Bollinger Bands have shown a cyclicality. Bollinger Band indicates volatility in the market, and when volatility has calmed down for a while in this market because we were on a steady uptrend, when volatility calmed down, it was akin to a correction or a break in that uptrend. And when volatility bottomed, that usually predicted, was actually a timing mechanism, indicator for the next rally in the market. Worked really well until we had the election correction. And at that point, volatility spiked, but not to the upside. As it turns out, volatility can spike to the downside as well. So we've had that kind of mismatch, that kind of noise in the signal ever since. And you can see that spacing there where I don't have any red lines indicating a correction or green lines indicating the onset of a rally. However, if this indicator is getting back in line, and if we are back on that uptrend, that green line marks the point where the volatility very recently collapsed again. In other words, the width, that bottom panel measures the width of the Bollinger Bands. So we are turning up from that right now. That should mean that we are well into another rally. These rallies don't last that long, 4 or 6 weeks, something like that. But it looks like we're probably a couple of weeks into that, which you would see from that earlier chart. I think we probably have at least a few more weeks. The question will be, of course, that correction, is it going to be like the previous ones where we just trade sideways for a few weeks? Is it going to be a steeper one? But right now, we look like we're okay short term for the next few weeks. In this market, the short term is the hardest to predict. If we look long term, we look at a lot of those factors, some of which I'll talk about, which mirror what Rick just talked about. The longer term factors, the fundamentals behind this bull market, make it the easiest to predict. The timing's always tough, but the direction is clear for a lot of the reasons that Rick showed and reasons I'm going to go into. Just a quick note on copper. We've had a nice rally in copper this month. It turns out that this, or it seems to be that this is an artifact of betting on the rebuilding in California due to the wildfires. This is an extraordinary natural disaster. It is most likely going to be the most expensive natural disaster in U.S. history. So this rally in copper, I think, reflects that. Therefore, I think it's more of a short-term blip. I am extremely bullish on copper over the long term, but I don't think this necessarily means that we are embarking on that big, huge rally where we're going to see eventually the copper price double. What's driving this bull market in gold? The key is we've entered the end game of a 45-year trend of ever easier money. This is the one chart that shows it all. What you'll see in blue here is the Fed funds rate. That's obviously the interest rate that the Federal Reserve sets. What you'll see in the red line is gross federal debt. Ever since Volcker killed off inflation in the 1970s, starting in the early 80s, he started to lower rates. In that case, it was normalizing rates. What you can see over this 45-year history is that the Fed has repeatedly lowered rates in reaction to a recession or any hiccup in the economy or any perceived oncoming recession. They always lowered rates, and then once rates bottomed, which you can see by those red lines, they attempted to raise rates again. Until recently, they were never able to get rates back up to past the midpoint of the previous range before the markets and the economy would demand more of that monetary adrenaline injected into its veins. Now, they did get past the midpoint in this last hiking episode, but in all fairness, they only had to get over 2.5% to beat the previous peak, which they did. But what does easier money and ever easier money promote? It promotes the accumulation of debt. Debtors win in this kind of an environment because the currency is going to get cheaper and cheaper, the money is going to get easier and easier. So that's where that red line comes in. That's federal debt accumulated through this policy of ever easier money. What happens, I mean, this is great, this is fine, you can go on with increasing debt if interest rates are always getting lower. But what happens when they stop getting lower? What happens when they start to rise? This chart shows on the red line, again, gross federal debt. On the blue line, federal government expenditures, interest payments on the federal debt. And you can see that red line keeps going. Yes, it's a steep line, but it's not spiking. It's rising ever higher. But what does spike are the interest costs, because the leverage on that monumental amount of debt that just a small increase in interest rates has means a tremendous difference to the bottom line interest expense. And thus, we are spending $1.2 trillion a year now in the U.S. just to service the national debt. That's more than national defense. A very familiar chart here, this is the U.S. debt clock. You can see as of a few days ago, it was $36.35 trillion in federal debt. That's not really the important number here. It's important, but the most important ones are those blue lines those blue circles at the bottom. In 1980, during Volcker's reign, when he had hiked rates over 20% to kill off inflation, he could do that because federal debt to GDP was only 34, 35%. He had all the tools he needed in his toolbox. Today, Powell does not have those tools. He wants to be Volcker, but with federal debt at 122% of GDP, he just doesn't have those tools. He cannot raise rates. In fact, my contention is he can't raise rates, interest rates above the rate of inflation, or the whole house of cards falls apart. In fact, if you're wondering why the Fed has been so adamant and so desperate to cut rates in the face of risk assets soaring, in the face of a still ebullient economy and a stubbornly strong labor market, that they initially cut by 5 or 50 basis points instead of a typical quarter point cut. This is why. This is the brick wall that's blocking the Fed. Nearly $1.2 trillion, again, being spent in interest expense every year. And it's going to get worse. A load of debt is about to hit because Treasury Secretary Yellen and her predecessors have been funding the federal debt through the issuance of bills rather than bonds, the short end versus the long end. This debt is coming due and has to be refinanced. There is nearly $10 trillion of debt maturing in 2025. That big line there, that big bar, rather, is 2025. You can see it dwarfs every other year in the amount of maturing debt. These chickens are coming home to roost this year. So where are we now? We are post-pivot. We don't know if the Fed is going to continue to cut rates, but because we are post-pivot, that big event that the Western traders were waiting on, they're now in the gold market. And unlike the steady, price-insensitive buying of central banks, this entree of Western investors into the gold market has created those wiggles in the uptrend line. These are those exhilarating rises and stomach-turning drops that will test your mettle and your conviction in this market. You know, there's a lot of bad comes with the good. There's big money coming into this market, and that will drive it to the next level. But we have to remain firm in our convictions, look at the long term, look at the horizon, and continually retest our premises and keep our eyes on the ball. Now, post-pivot, we should do fairly well if the Fed continues with rate cuts at some point. And again, they're going to be desperate. They're going to look for any excuse to continue rate cuts. Gold gained more than $800, over 45%, during the harshest Fed rate hiking cycle ever. That green line is the Fed funds rate. We have never seen interest rates hiked to the degree that the Fed just did in the history of the Federal Reserve, likely in the history of central banking. And gold did spectacularly well. But markets aren't buying what the Fed is selling. The Fed started to cut rates. You can see that represents the 75 basis point rates that they've already done. But almost coincident with their beginning of rate cuts, with their pivot, you can see that gold line, which is the U.S. 10-year Treasury yield, started to rise. Yields are rising. Now, my contention has been that unlike the typical scenario where falling Treasury yields indicate safe haven investing because investors are buying Treasuries for a safe haven and therefore driving rates down. In some instances, rising yields reflect a safe haven concern because investors, bond vigilantes, are demanding a higher return given the risk that they see ahead. That is one reason why we're seeing the 10-year yield rise, because the markets, investors are seeing the conundrum, the debt trap that the Fed is in. If we look at gold and the gold line plotted against a 10-year yield, you can see that there is no relation. There is not a positive relation. There's not an inverse relation. There's both. No matter where Treasury yields have gone, gold has consistently risen. That bottom line, that bottom panel shows the rolling 20-day correlation between gold and the 10-year Treasury yield. Anything above zero, that dashed line indicates a positive correlation. Anything below shows the typical inverse correlation. It's been all over the map. Gold has been rising whether Treasury yields are rising or falling. Gold versus the dollar index, again, if you look at that correlation, it's all over the place. The dollar has strengthened, the dollar has fallen. Treasury yields have risen, Treasury yields have fallen. Throughout it all, gold has risen. It has surely been the all-weather investment in this scenario. The bottom line is that we have a long-term, monetarily based gold bull market in progress. And if you're looking at how to play this, if you're looking at the junior mining stocks, this is a generational opportunity that harkens back to the turn of the century. Let's look at long-term gold as one indication of the long-term gold price, one indication of where we can go. This is a little hard to read, but there are, in my mind, I count 3 major bull markets in gold: the early 70s, the late 70s, and the 2000s. The early 70s, the gold price from trough to peak went up 5.6 times. The late 70s, 8.2 times. The 2000s, 7.5 times. Where are we going from here? If we mark the bottom of this cycle at about $1,050, then we should go up probably 7 to 8 times from that in this bull market cycle at the culmination. That means $7,000, $8,000 gold, somewhere in that range. If we do that, and I think we are, again, the timing is uncertain, then all of these companies that you see exhibiting here are going to be selling for, safe to say, many times their current share prices. If you look at the NASDAQ 100, this is another powerful chart, which is the mainstream tech stocks, the more euphoric stocks, the more speculative end of the mainstream stock market. The NASDAQ, despite the 100 divided by the gold bugs index, the last time we saw things this out of whack was the early 2000s. Now, currently, we've clawed back a little bit of that extreme undervaluation relative to NASDAQ, but there's still a long way to go. This is an extraordinary opportunity. That's it. I'm way out of time. I'm goldnewsletter.com, New Orleans Investment Conference this coming November.